Hello and good afternoon and welcome to Company Accounting Tonight. I'm your host, Hugh Phillips. Today with me I have three important analysts who are going to help me in explaining financial accounting standards on the accounting for income taxes, impairment loss, accounting for leases and the application of positive accounting theory and how all this was done using secondary data from two very important ASX listed companies. So, joining me today as my first guest is world-renowned expert on deferred tax assets and deferred tax liabilities, Oliver Greaves. Oliver, welcome.
Thanks for having me on the show, Hugh.
Anytime, mate. Now, before we start, can you please explain to me which two ASX companies you use for your report and why you chose them?
So we used two companies which we knew were big and would have a wealth of data available to us.
Yep.
And these companies were Qantas and CPA.
Perfect. Now, using those two companies, how is the recording of DTAs and DTLs misleading for most users?
So upon review of the ASB 112, the recording of both deferred tax liabilities and assets in the financial statements can both confuse and mislead general users. And I believe this comes down to the general fact that users do not simply understand what these are and what their purpose on the balance sheet are.
Yep.
Deferred tax liabilities and assets are pretty simple, and they arise from the difference in reporting disclosures from that of the ASB 112 and of the Tax Assessment Income Act. So when interpreting the explanations provided within the ASB 112, it appears both DTLs and DTAs are relatively simple to understand. However, when examining a bit deeper, the ASB 112 becomes apparent that there are certain issues that seem to arise in the way the DTAs and the DTLs are reporting on the balance sheet to become misleading and confusing. Specifically, instances where temporary differences do not result in the recognition of DTLs and DTAs.
Right.
An example of this
Please excuse us, from coming back from technical difficulties. Oliver, you may continue.
Thank you. So, however, despite the confusing explanations provided within the ASB 112, I believe that the root cause of the confusion in regards to DTLs and DTAs is that users do not understand why carrying amount and tax bases are different.
Yep.
As the tax base is the amount attributed to the asset or liability for tax purposes, and the carrying amount is the value in which an asset or liability is carried on the financial statements, I believe users struggle to understand the difference between the two. I believe confusion can also be amplified by things such as depreciation and R&D expenses, as well as goodwill,
Yep.
and how that all ties into the ASB 112.
Perfect.
In conclusion, I believe that DTAs and DTLs can be confusing to the users as they may struggle to understand how they report on the financials as well as their tax effect. Furthermore, I believe that the root cause of DTLs and DTAs to become misleading is that users simply struggle to understand the difference between tax bases and carrying amounts.
Well, Oliver, thank you for that perfect explanation. I'll see you later.
Thank you. Thanks for having me, Hugh.
Anytime,
See you
mate.
next time.
Now, I'm going to talk about case study 2, which involves how the use of subjective judgment, assumptions, and estimates can affect the magnitude of timing of how an impairment loss is measured. Impairment loss of assets, such as goodwill and other intangible assets and property, such as plant and equipment, are measured under the ASB 136 impairment of assets. This is a hot topic in the accounting world for two main reasons. Firstly, many entities find themselves in a tough trading environment, constantly making it harder to justify the value of assets. Secondly, there has always been an intense regulatory focus on impairment over the last few years, which is evident in response to ASIC's inquiries about companies continuing to use unrealistic cash flows and assumptions in estimating recoverable amounts. Impairment recognition and measurement is regulated by AASB 136, as I mentioned earlier. The general threshold for when determining impairment loss is based on the lack of recoverability of a carrying amount within an asset. Most businesses impair long-term tangible assets, and once an asset is deemed to be impaired, the business is able to calculate a loss to equal the difference between the net carrying amount and the fair value of the asset. AASB 116 requires that an asset are acquired at cost less any accumulated depreciation and accumulated impairment losses. However, as an alternative to the cost model, AASB 116 allows the revaluation model to be used for certain assets. It is extremely important that revaluation must be made regularly and also must apply to every single class of asset. The use of subjective judgment, assumptions and estimates can affect the magnitude and timing of how an impairment loss is measured. Estimates such as an adjustment of carrying amount, depreciation, goodwill, warranty claims or bad debt of an impaired asset can immediately disrupt the measurement and timing of impairment loss. Subsequently, if a cash generating unit is unable to compromise an asset, which is to be identified consistently from period to period, the carrying amount and recoverable amount will not be determined, which can then, in turn, affect the magnitude and timing of how an impairment loss is measured. In turn, the measurement of impairment loss inversely relates to the use of positive accounting theory. Positive accounting theory views a company as the total of contracts that they have entered into. This theory states that because a company is fundamentally about the contracts that dictate business, a core driver of a company's success is efficiency. In other words, positive accounting theory examines how companies account for certain events and seek to understand the economic consequences of those decisions. The theory then tries to predict how companies will account for transactions and certain events in the future. Subsequently, this theory is useful to explain a manager's preference or reluctance to recognise impairment loss. Watt and Zimmerman, 1986, claims that managers with high debt levels will tend to take actions that result in increased profits. This may induce radical behaviour in regard to impairment recognition to the extent that companies may be affected by the impact in regard to profit and leverage ratio. The influence of companies being exposed to several markets that differ from their national markets creates higher visibility, leading to prudent management behaviour concerning risks associated to impairment loss recognition. Now I'm going to cross through to our Sydney and Melbourne offices, where Kinga and Trisha, our two experts, are going to explain to us how manager-lender agency relationships and owner-manager agency relationships are affected by senior management of Bolte Transport Limited, and how they may be reluctant to adopt AASB 16. Girls?
Thanks, you. Now to start with case 3. In relation to managers and lenders' relationship, managers are more reluctant to adopt AASB 16 due to the leverage constraint from lenders and there being remuneration bonuses in place. The managers have a leverage constraint not to exceed 60%, which under AASB 117 is 50%. They also receive a bonus if pre-tax return on assets is above 15%, where under AASB 117 is 20%. Under AASB 16, the leverage constraint increases to 66%, and return on asset decreases to 13%. If Bolte Limited exceeds the leverage constraint set by lenders, the interest rates will increase as it is more risky for lenders to invest. With pre-tax return on assets being lower than provided amounts, managers also miss out on the remuneration bonuses. Now I'll pass it on to Kinga.
Thanks, Trisha. Now moving on to the second part of this case, the senior management of Bolte Limited are reluctant to adopt Luke's proposal, which is adopting AASB 17. The core reason for this reluctancy is said to be that the standard doesn't appreciate the incentives or bonuses that is otherwise available with the AASB 16. Remuneration and bonus plans are important in an organization because it encourages the management to align and work in the best interest of the company. Since the company has a separate ownership and control, it is more likely for managers to go off track and only act in their interest. Rewarding them with bonuses helps avoid these things and achieve targets. A study by Perry has found out that rewarding with bonuses has a good impact on the functioning of the directors. A criteria for a bonus in this case is if pre-tax return on assets exceeds 15%, but the calculation only amounts to 13%, and furthermore there is no material effect on profit. This leads to less chances of fulfilling the criteria, therefore leading to less chances of getting a bonus. So the senior management of Balti Limited are not happy with Luke's proposal and have decided not to go with the adoption of AASB 17. Now Hugh will take it from here.
Thanks, girls. Now, to wrap up tonight's show, I'd like to thank our three guests, Oliver, Trisha, and Kinga. Oliver was clearly able to show that DTAs and DTLs are misleading due to the fact that users are unable to understand the difference between tax bases and the carrying amount. As for myself, I was able to show how subjective judgment, assumptions, and estimates can affect the magnitude and timing of impairment loss. And Trisha and Kinga were able to show how managers are reluctant to adopt AASB 16 and rather stick with AASB 17. That's it for me this afternoon. I am your host, Hugh Phillips. Stay classy, UC.